And good morning, good morning, good morning, good morning. Welcome to Thursday special real estate update Q&A from the members of the Facebook group. So of course, we are broadcasting live here on onedealaway.com/live. And of course, we're also broadcasting live on Facebook at the moment because I wanted to try to see if we could do, two groups at the same time. So today, in today's episode, I wanted to go in and talk about what's going on in the real estate market. And, we have some news from New York. We have some news from Chicago. We have some news from a billionaire, Sam Zell, that talks about real estate and kind of the economic shifts and stuff that we're going to briefly take a look. We have some really exciting news from Mortgage Bankers Association talking about credit availability, talking about the share of mortgage loans in forbearance, talking about the applications to those puppies as well. And then, of course, we have some information from the National Home Builders Associations that we're going to talk about, like multi-loan family purchase caps, single family, kind of what's going on. There's some excitement for the builders. With the builders, maybe I should turn on some better lighting. I don't know how you feel about that. Maybe you like it, maybe you don't. And then, of course, Airbnb APO could generate billions for the Bay Area, but what will the impact be on the housing? That was the piece that we've announced here on onedealaway.com channel on this channel right here to talk about today when we were talking about the Airbnb IPO and how Jeff Bezos is going to walk out with millions of dollars, as well as all of the other early investors. So here is education for all of us. Sometimes you got to be in early, even when it's uncertain, in order to kind of, benefit. But of course, there are risks to that. There's a lot of patience that has to happen with that. And you can't gamble the money you can lose. It only has to be money that if you lose, you're still going to be okay. I mean, it kind of sucks if you lose it, right? But at least you're going to be okay. I do want to welcome everybody who is watching this live on onedealaway.com/live. And I want to welcome everybody who is watching this live on Facebook Live on Real Estate Investing Secrets. Good morning, good morning, good morning. Happy Thursday. We're starting this a bit earlier because we have quite a few things to cover, and then Nev has quite a few things to do on his own today. So that's why we're doing this slightly earlier, but I think it's going to be all right. I also want to welcome everybody who is watching this elsewhere. Maybe you're watching a replay on Facebook. Maybe you're watching a replay on YouTube. Say hello, subscribe to the channel, give me thumbs up. Let's help me, help you, help everybody else around to spread these news and help people out, discover the channel, but then also be able to learn to potentially, make and preserve the wealth that they have, because both are equally as important, I would argue. So that's kind of what the show is today. We also have quite a few listeners that are just listening to the podcast. And today's episode is going to be all about real estate. So if you're passionate about real estate, it's this is the show for you. So without further ado, let's do this, y'all. All right, all right, all right. So here we go. Let's go ahead and take a look at what's happening with the news. Let's see what's happening with the news. And as you can see, Airbnb IPO could generate billions for the Bay Area, but how will housing prices react? Well, Airbnb unveiled long anticipated plans to go public on Monday. We've been discussing that, I want to say Tuesday maybe. The stock offering, which could take place as soon as December, will likely make Airbnb's founders and investors billions and turn many employees into millionaires. So there's going to be many people that are going to be swimming in quite a bit of cash. And the question is, well, how is the Bay Area, which is where the headquarters are, going to be impacted? Now, one of the things that you may or may not know about Airbnb is that it currently has 7.4 million listings run by 4 million hosts worldwide. 86% of those homes are outside of the US, and 55% of the hosts are women. So this is actually kind of cool that, this is one place within the industry, within the financial sector, is, money piece, that there's more women than men. And that is super exciting. And congrats to all of the ladies running that. Hopefully my fingers crossed that it's super profitable for you. And it's very, very exciting to be able to see that stuff. But it's interesting piece to understand that 86% of all hosts are actually outside of the United States. Now, this is important for us to understand of kind of what their numbers are if you're going to invest in their IPO. But I think for us as real estate investors, right, if we put that hat on, Airbnb has been very powerful to help us to be able to make quite a bit of money, right, by short-term rentals. And we do know that there are many individuals within the spectrum of real estate investing that will go in, buy some homes, and then Airbnb those puppies because profit margins are much higher, right? So you charge per night, which could be sometimes even few $100s, sometimes a few $1,000s if you are in right place, right time, and there's a housing crunch, right? But we've also seen people house hack with it and do all kinds of cool and crazy things, and that is super exciting. Now, of course, Corona Roni has created a lot of problems with that. So it slowed things down, but nonetheless, it's still important to understand that that has been a very important piece. And then, of course, we also know that some of the folks who have been relying on Airbnb income have been severely hit. And so some of their properties might be going into foreclosure, forbearance, that kind of stuff. And we're going to be talking about that in just a moment. So if that's what you're waiting for, well, you don't have to wait too long. We're going to cover that today. The wealth generated from offering will add a little pressure, lifting Bay home areas potentially, but those are already pretty pricey, although the prices, especially within the rentals, have started to come down quite a bit, and they might add a little extra pressure. However, it's probably going to be immeasured because here's the thing. The bulk of workers are not required to show up in the office, and they have employees all over the US. So even if there are these boosts in their paychecks and stuff, that makes sense when we see the prices kind of go up when there is a change, when something goes public, right? And then people kind of live within the hub and we see them go out and, buy more homes and stuff. And then that's when you can see a very concentrated price increase. However, that's not going to happen with Airbnb because, well, they're all over the place and they can live all over the place as well, and so that's what makes a big difference for them. So that's something for you to kind of be aware of. All right, time to go in and take a look at single family starts and highest pace since 2007. We're going to navigate to what is going on with the Home Builders Association. As you know, housing starts means that, like, what are they starting now and how is that going to impact the inventory? Right now, we'll tell you that the sentiment within the home builders is the highest that it has been for quite some time. They're very, very bullish. The challenge is that when the housing starts increase tremendously and it increases for a long time, but then the demand starts to slow down, we can see a surplus, which is what can upset the prices. So that is the part that can actually make the prices, start tumbling down. So if we take a look at this with potential some of the challenges with the forbearance, unemployment, that kind of stuff, those things could potentially drive the home prices down. But again, I don't expect that to happen in the first quarter of 2021. Maybe second quarter, more likely third quarter or fourth quarter. So we're looking at good solid 6 months from now plus, right? So that's the potential piece. But let's take a look. Overall housing starts increased 4.9% in October to a seasonally adjusted annual rate of 1.53 million units. Single family starts increased 6.4% to 1.18 million seasonally adjusted annual rate and are up 8.6% year to date. The pace of single family starts was the best since the spring of 2007. So this is a potential reddish flag right here for me because remember, the best start was in 2007. What happened later on? Well, later on came 2008, and we all know what happened in 2008. Kaboom. That's right. So the multifamily sector, which includes apartment buildings and condos, remain unchanged. So this is a little bit on the bullish side for those of you that are looking for multifamily. Now, in case you haven't been watching the channel, listening to this stuff, right, and paying attention, or not a student, you might not necessarily understand. But multifamily is going to be anything with 5 units or up. So that's something for you to understand. So it doesn't necessarily have to be this whole, like, 200 units, 5,000 units, although it can, right? But just kind of to understand what that means. Builder confidence index in the Builder confidence index single family starts continue to grow. Single family permits were approximately flat in October, which suggests housing starts will level off in the months ahead. And this is on the side of, like, okay, this is good, because if it was to continue to rise, remember, anything that parabolically goes up parabolically comes down sooner or later. And so the fact that it's kind of like it's risen, right, and it's sort of slowing down, but then again, that's very typical for like winter months, that things starts to slow down. Typically in spring we start to see a pickup again. So we'll see what that is going to look like in a few months. Builders do cite a lack of lots and decreased availability of building materials as headwinds. So this could potentially be good for us as investors right here. Of course, if you own lumber and building materials, then hey, this is really cool. Just provide it to them if you have it. The challenge is that the prices are up and there's a bit of a lack of a supply right there. We've been talking about that on the channel for a little while. But when they're talking about the decreased availability of lots, this is the part that could be very beneficial to you if you follow the process that I explained in Real Estate on the Cheap channel challenge. Well, it's channel here, challenge there. So Real Estate on the Cheap challenge is it's a 30-day program that I believe is ridiculously affordable. And folks that are in the challenge, because once you join the challenge, you're in challenge for life, so it never expires. So that's one cool thing for you to know. But those of you that are on Facebook and watching this, let folks know that if you've gone through the challenge, let them know, what is your experience about it? Good, bad, ugly. What I have heard, all of it has been good, but is it possible people are lying to me? Sure, anything is possible. I hope they're not. But I will tell you, nobody has asked for money back. I can tell you that much. So we do offer money back. And it's yours to keep forever. You don't have to complete it in 30 days, but you can if you want to. And it really teaches you how to buy these darn lots, for, dirt cheap. And now you have them. Go find yourself some builders and sell it to them at profit, right? This is where Flip It Online Masterclass goes, because it teaches folks how do I, buy these things, but then also how do I flip it? And you can flip it not just to end user like you and I, right? Like a regular old mortal, but you can flip it to the home builder. Now they're super happy because they have a place to go and build. So you make money, they make money, and hey, a new homeowner gets a house and they are happy. So it's a win-win-win situation, which I love. Combined single family and multifamily starts are 15.5% higher in the Midwest, 7.5% higher in the South, 4.7% higher in West, and 6.4% lower in Northeast. So this is an interesting thing to kind of see what's going on. I think there's some desire or potential belief that many people will move into the Midwest, right? And so maybe that's the reason why they're jumping in and starting to build homes over there. So there's a potential that we could see an overbuild in the Midwestern region of United States. I personally am kind of excited about the fact that 6.4 is lower in Northeast, that we're actually dropping there. And the reason for that is because it's fairly densely populated, and without adding more to it, and we know that folks are moving out of Northeast, the fact that we're not building and adding more supply here is very good, because it will most likely create flat prices, right? Like they're not going to come back down tumbling as high, and will continue to rise. So for investors in Northeast, this could be a very, very good thing. We also, have seen that folks are talking about, well, people are moving out of the New England, they're moving out of California, they're going to the Midwest, they're going to the suburbs and stuff. But remember, I told you Sam Zell is a billionaire investor. He's huge in real estate. Um, and he has some sort of pieces of wisdom to share with all of us that I'm going to share here with you today, that might make a bit of a difference for you to think of, like, is this going to happen? Is this not going to happen? And is urban thing going to die off completely? I don't think it will, but we'll see what he has to say. Hold on. Okay, now, what is going on with the Fannie Mae, Freddie Mac multifamily loans purchase caps? Because you might be a multifamily developer, builder, investor, and so this is important for you. They have announced that 2021 multifamily loan purchase caps are 70 billion for each, and they're offering combined total of 140 billion dollars in support to the multifamily market. So this is very, very big. And yes, if you didn't know, both Fannie Mae and Freddie Mac do offer loans for multifamily home builders. Oftentimes, it depends on the size of the loan. Typically, we're talking millions or tens of millions of dollars for the project, sometimes even hundreds of millions. And depending on the size and so on, the rates are still ridiculously affordable. Sometimes you can find them even more affordable than the 30-year mortgage stuff, which we're going to talk about in a moment. And you can also sometimes get it for 40 years. You can get 40-year mortgage loans for these puppies. Now, of course, at least 50% of the money that exists is going to go into the affordable housing. And for the first time, affordable housing, manufactured housing communities must enter to be resident, government, nonprofit owned, or must have tenant paid lease protection to be counted as mission driven affordable housing. So why is this? Well, they used to have affordable housing, and so many developers will jump in and say, yeah, we're going to do affordable housing, but then they would build it with the money slotted for the affordable housing, and then once they start renting, they sort of like the affordable piece goes out the window. So that's one of the things for you to pay attention to and to kind of know that, it's not just that, but we'll see how that all rolls out and if everybody's going to tap into it. There are some cool strategies that you can do with the manufactured housing, because if you're looking to build most of the houses, or houses and multifamily are built what is known as thick construction, which is basically lumber, right? And you've seen it. And that can get kind of pricey and stuff, and the margin is super, super low for affordable housing, which is why everybody's building those type A properties. And if you don't know what type A properties are, well, One Deal Away Academy will help you with that, because in the courses we teach about that stuff as well. But manufactured housing could be a very, very cool place, because you can get them, relatively speaking, affordably. And now you can get like really good loans, and if you put it out there where you can rent it for $500 to $700 a month, you will have hundreds of applications coming your way, because people do need affordable housing, and because the cost of manufactured housing to kind of get in is low, your margins are still really, really good, so you could be very profitable. So there you go. That's kind of what's going on within the home builder section, kind of the development of what's going on with that stuff. Now it's time to look at the mortgage applications and see where the market is going to go overall. Mortgage applications decreased 0.3% from 1 week earlier, signaling, as it has been signaling for weeks, that we're seeing this sort of like slowdown coming in. We're seeing a little bit of cool down in it, which means that the prices will likely stop climbing as fast as they have, which is a good thing. And that we might see a bit of a flat. Could it go down potentially? Sure, that is also a possibility. The refinance index increased 2% from the previous week, but the purchase index increased 4% from 1 week earlier. So we're seeing that these indices are rising and doing some interesting stuff, but overall the applications are down. Mortgage market activity was mixed last week, despite the 30-year mortgage staying below 3%. The refinance index decreased last week, driven by sharp declines in FHA and VA applications, which means that those that are applying are no longer, veterans are not applying in high droves, whether they have just given up on it or everybody that was interested has already finished applying. And same thing goes for FHA. This is the part where maybe you are getting a different, like a non-standardized loan of wanting to put a little bit less, or you have maybe not as stellar of a credit. The adjustable rate mortgage share activity decreased 1.9% of total applications. FHA share of total applications decreased to 10.5%. Small decrease, but a decrease. VA share of total of applications decreased to 12.1 from 12.6. So we've seen much higher depreciation decrease here. And then USDA share total applications decreased to 0.5% or increase, sorry, from 0.5 to from 0.4. My gosh, I can't talk today. So it has gone up basically 0.1%. And USDA loans are really, really cool if you can qualify for them. Often they're easier to get, often they're cheaper. We did cover it on this channel. Not many channels talk about USDA loans, but we do talk about it here. And if you want to watch that video, you will find it in the YouTube channel, Money Matters, and then go over to real estate section and you will find it there. Average contract interest rate for 30-year fixed rate is increased to 2.9% from 2.8. So the mortgage rate went slightly up, but we're still below 3% on average. And points did increase from 0.35 to 0.37. And that's, of course, based off of the 80% LTV. LTV is loan to value ratio, and a lot of the times lenders, and those of you who are thinking about being lenders, because that season is potentially coming our way. And of course, we're going to be adding a course on onedealaway.com about how you can be a lender in real estate if you want to. And then if you join the academy, you just get that part free, because when you join the academy, you get all of the courses for one low monthly subscription payment. With points, we're increasing. Okay, we've covered that part now. Moving on. Average contract interest rate for 30-year fixed rate mortgage backed by FHA increased to 3.11% from 3.08%, with points remaining unchanged at 0.37. You will notice that everybody has 0.37 points as we continue going through this article. And you can see that FHA is slightly more expensive, but you do put down less money. And then, of course, at some point later down the line, when you pay down some of the equity, or you're able to raise the equity through your, they call it sweat equity, to your work and stuff, or through increase of income. If you have multifamily, then you can refinance to a different thing. 15-year fixed rate mortgages increased to 2.59% from 2.55, and points are decreased to 3.5. 5-1 ARM increased to 2.84 from 2.79%, with points increasing to 0.53 from 0.42. So as you can see, the ARMs are not the best deal, and you shouldn't be doing it. And that tells me that the bankers are believing that the rates are not going to go up, because only when they can get you into something they can make more money, that's when they make that a bit more affordable. So they do expect that the rates are going to stay flat or go down still, which will be interesting. All right, so what's happening with the forbearance, right? We've been hearing all these crazy stuff about forbearances, and forbearances are going to come in, and in January prices are going to come down, and there's going to be this multitude of foreclosures, and it's going to be like 2008 on steroids. And while that is still possible, there is a bit of interesting and exciting news for me personally, because I don't want to see a calamity happen in the world, right? And we're seeing a decrease. So the Mortgage Bankers Association latest forbearance and call volume survey revealed that total number of loans now in forbearance decreased for the 11th week in a row, from 5.67 of service portfolio volume and into the prior week of 5.47 as of November 8th. So this is good. Share of Fannie Mae and Freddie Mac loans in forbearance dropped 13 basis points to 3.36. Ginnie Mae loans in forbearance decreased 25 basis points to 7.7. And Ginnie Mae was the riskiest of the groups. So seeing a decrease here is huge. Declines in the share of loans in forbearance continued this week with a significant increase in the rate of forbearance exits. More than 76% of borrowers in forbearance are now in extensions, as we are well past the 6-month point of most borrowers' forbearance plans. And as you know, you get 6 months, then you get to extend it for 6 more months. So we'll see. This is still, we're not out of the woods yet. I wouldn't go out celebrating. We could still see some drops and stuff. But I think it's key to understand that we're seeing this starting to lower. Now, 30.6% represented borrowers who continue to make their monthly payments during their forbearance period. This is good. Not, right? So this lets us know that not everybody who's in forbearance is not paying anything, right? We're seeing that folks are continuing to make payments. Almost 24% resulted in loan deferral partial claim. 17% resulted in reinstatements, in which part past due amounts are paid back with existing forbearance. 12.8, almost 13% represented borrowers who did not make all of their monthly payments and exited forbearance without a loss mitigation plan in place yet, so that's not good. 7.1% resulted in loans paid off through either a refinance or by selling a home. So that's how a lot of these things have happened. 6.8, so almost 7%, resulted in a loan modification process. And then the remaining 2% resulted in repayment plans, short sales, deed in lieu, and other reasons. So they're basically kind of getting out. So they're working through these forbearances, which is a good thing. So they're not just sitting on it. Abandonment rates did increase from 6% to 6.3%, and that means that basically folks are sort of getting out of the Dodge, turning over and saying, it's yours, I want nothing to do with this, and just moving on. So we will definitely see an increase in foreclosures. I just don't think it's going to be as huge. And again, I think these are going to start rolling in the next few months, but it does take time for this stuff to clear, for this stuff to change. Okay, so mortgage credit availability is increased in October. This is also very good news, but it's not super exciting. So we're seeing a little bit of mixed news, as you can see. Mortgage credit availability increased in October according to the Mortgage Credit Availability Index, MCAI. Is that how you call it? MCAI. It rose by 2.3%. Now, a decline in the MCA index indicates that lending standards are tightening, so money is not getting out there, while increase in the index indicates that we're loosening credit. So we're seeing that it's a little bit, getting a little bit looser, which is a good thing because they're helping folks out, but it's not all that exciting, and you'll see in a moment. Credit availability increased in October for the first time since July. The ongoing economic recovery and improving labor market led to a rise in credit supply for various loan types. There was an overall increase in credit availability for low credit scores and higher LTV loans, with conventional credit supply increasing 5.1% and government credit staying essentially flat. Despite October's slight turnaround, credit availability does remain constrained to a near low seen in 2014. So it's interesting, right? Because 2014 kind of came after that, 2008, 2009, everything ginormous crash, and then we've gone into 2009, 10, 11, 12, sort of clearing of the foreclosures throughout different states and different markets. And then, we were still kind of constrained in those periods. And those were the years where being a private lender, hard money lender, was a great time to be. And you could make some really, really good money. And so we could potentially see that coming our way as well. So if I combine that there is a bit of tightening, well, they have loosened it up, but we're still basically as tight as we were in 2014, prior to the increase of the ability to loosen everything up, and then prices starting to go back up. when we combine that with the 2007 sort of home builder stuff, we could see that potentially in the upcoming 12, 18 months or so, we could see some really interesting moves in the real estate market. That again, combined with some of these foreclosures, again, there's going to be a shift coming in, and it could be highly beneficial to those who are looking to invest. There was also an increase in ARM loan supply, likely driven by the September 30th deadline for LIBOR ARM loan applications. More lenders rolled out SOFR arms following the deadline. Now, if you know and don't know anything about it, LIBOR is the London interbank market of kind of like a borrowing rate, and that is going away. A lot of the variable rates for mortgages, for cars, for personal loans, and that kind of stuff follow LIBOR. LIBOR is going away in 2021, which is what, like 5 weeks away, something like that. And SOFR is what is coming and replacing that stuff, and many banks are starting to roll over to this new process and new sector. So that's something for you important. If you don't know what these are, make sure you take a look at that and look it up online and see how it may or may not impact you and your loans that you may or may not have. All right, so this is Sam Zell. This is the guy that we've been talking about, and he is, a gentleman that doesn't mince his words. He's almost 80 years old. He's been in real estate for forever, and as well as many other places and markets. And so they did an interview in Forbes with him, and I'm not going to read the whole thing. You can definitely read the whole thing if you want to. I just want to point out a few different questions that he was asked and the answers that he provided. So, one of the questions that was asked was, interest rates are historically low, which obviously helps the valuation of your real estate. Any chance we will see zero or below on the 10-year treasury? And as you know, 10-year treasury does follow in the guide of what's happening inside the mortgages. So this is Zell. I don't think so. The challenge of the next few years is to keep interest rates as low as possible. I think the risk of inflation are much higher than the risk of deflation, and we'll see if he's right, but there's a potential for it. Rates have to stay low because we can't afford to pay back it in higher rate that we are dealing with today. This slows down the whole economy. And he's saying very low interest rates result in deferral of decision making. And so he's saying, yeah, probably not. Again, it's possible we hit it, but the rates likely won't go up. They just can't right now. They might naturally go up and climb up as folks are sort of, doing funny stuff with the bonds, but they're here to stay for a long, long, long time. So as much as they try to rush you in some of the news articles and stuff, we've been seeing some of the moves that we're seeing in the mortgage rates is like, 0.01% up or down. Like, that's basically flat. Second question that he's been asked is, you've been a follower of megatrends, making real estate investments around expectation of what the baby boomers are going to do, for example. What are the trends you still hold on to, and which are you discarding? So Zell responds, the number one megatrend in my head is an un-megatrend. All this discussion about the end of urbanization and working from home, and the world is going to change, and you're going to live in no place, Iowa, and you're going to work for a clothing company. It's not going to happen. We're social animals. I'm happy to be very clear that I think people are looking at this current lockdown and extrapolating results that are preposterous. So I don't know how you feel about it. I think in a short term, of course, I think we're going to see people leaving, and they have been leaving. But, I do also agree with him. We are social animals. We are social creatures. We do know that these lockdowns, for example, are having severe mental health impact on individuals, and not in a good way. And so, people want to be around and out. What I think is driving is this COVID era thing. Again, let me know how you think about it. I do think that some of the folks do want more space and stuff. I think that there is room to rethink urban living and the spaces and those kinds of things. But I don't think that that the cities are going to die off. They're just going to change of who's going to live there and how. However, speaking of cities, you might be seeing on the screen right now that I have this new at 6 GN9 news. And we're going to take a brief look over here at what's happening in Chicago. If you are thinking of being an investor, if you're an investor, paying attention to the taxation of the real estate property is absolutely huge. So today we definitely want to go in and take a look at the rates of what's happening, with the taxation and so on. And Chicago is a prime model of kind of watching what's been going on. So I am going to stop yapping for a brief moment, have some hydration, and we are all together going to listen to a bit of what this is and why I brought it up, and I will come with a commentary, I promise. So here we go.
New at 6, property taxes on steroids. A new report from the Cook County Treasurer is unveiling what many already know. Property taxes have increased far more than wages of the cost of living, I should say. Prime example is this home in Logan Square. Since 2000, taxes have gone up more than 300%. That home's notable because it's owned by Mayor Lightfoot and her wife. But theirs isn't the biggest increase.
No, WGN's Sean Lewis now takes a deeper look.
Around the city, you see money, buildings tall and short, all with one thing in common: property taxes.
All taxing districts.
In her second floor office, Cook County Treasurer Maria Pappas is the person who collects it all. And today, she has a warning.
This is a wake-up call. When you put this much data together on 2,200 governments, there's no way anybody can ignore it.
In March, at the beginning of the pandemic, her office took on a big project, pouring through 20 years of data to come up with what she calls the Pappas Report, cataloging the steep rise in property taxes in Cook County and in the city of Chicago. And what she found:
It was already bad, but now it's really bad.
First, a little perspective, working off her numbers. Since 2000, the cost of living in the area has gone up about 36%. Wages have gone up almost 57%. Meanwhile, in suburban Cook County, residential and commercial property taxes have gone up, on average, 87%. And in the city of Chicago, it's 114.8% on average.
All right, so I want to pause over here just to bring this to light, because not that I need to, because I think you're figuring it out. But look at this. The cost of living, of course, is up. The wages are up and stuff. But look at the property taxes. So for homeowners, this is really painful. But it's also very painful for real estate investors, because, this thing right over here, right, the cost of living and the wages impact your tenants, right? And so, but this impacts you as a landlord, which means you gotta raise the rent within the place. But folks that are renting might be struggling, and this is sort of where we see this sort of kaboom thing happening. And there was one of the individuals within the Facebook that has posted a question about raising rents that I'm going to answer at the end of the show. So stay tuned for that. But let's see what they say, what they continue to say, because this is really, really important, y'all.
Average. And at the upper end of that average is this modest house on West Cortland in Bucktown, where since 2000, property taxes have increased from about $2,800 a year to more than $19,000. That is a 573% increase.
So nearly 600% increase in the property tax. Nearly 600% increase in a property tax. That is huge, y'all. That is absolutely huge. So imagine you buy a house, right? And this is something I do want to share. So if you know this, you can skip this section. But if you don't, many new home buyers, many new investors don't know this stuff. I didn't know this stuff. I learned it the hard way. When you go out there and you're looking for a home to buy, and you start looking at the stuff, you focus on the prices. Most of us don't even pay attention to the taxes. You're like, whatever, and so you just focus on the home price. When you buy typically, they calculate your payments and stuff off of the taxation. But when you buy, more often than not, because the governments are not so good at keeping up with the times and stuff, and sometimes they're too good to keep up with the times, they don't always reassess the property value, so the taxes kind of stay lowish, right? When you buy, they see a brand new price and they're like, "Woo, look at that stuff, we got to reassess." So you could see this bump in the price, and all of a sudden, when you were planning that your, say, taxes are going to be $2,800, all of a sudden they end up being $5,000 for a year, or in this case scenario, they rise to almost $20,000. That is insane. That is absolutely insane amount of money. They've gone from $2,800 to nearly $20,000 in taxes, and so of course that is highly problematic. And you need to understand that stuff before you go into it, and you need to look when you're looking at where to invest, where to buy. A lot of times what we buy and where we live might be dictated by the family, the jobs, the schools, and that kind of stuff. But I think if you have flexibility, and typically you have flexibility with investing, look at the places that are going to be a bit friendlier to your home ownership. And I fear in Cook County and in Chicago, this is only going to continue to rise up. And I wish that I can tell you that Chicago was the only place that this is happening in, but it's not. It's not. It's happening all over the place. And it's really, you got to put in a lot of due diligence and plan for the increase so that you don't get blindsided. Zillow does something very interesting, not chilling them or anything like that, but I do like what they do is that often, not always, but often when you take a look at a property, whether to buy or is researching for something else that you're trying to do with the property, take a look at the historical taxes. They don't always have it, but often do. And you can see kind of how the movements have been happening and what's been going on. And I think this is really important for you to do. Now, I have another video over here, and now we go from Chicago to New York, and instead of focusing on taxes, we're going to be focusing on the pain points for landlords, because I think this is really, really important. This hits, close to home, close to heart for me, because I am right there with all of the other landlords. I mean, I do own properties for rent, and it's very, very challenging when you have all of the protections kind of come in on one side but not on the other side, and it does feel very one-sided. But again, I am too close to this to be objective, so I want to be completely transparent with you, but I am curious to know how you feel about the whole thing. But let's take a look and listen to what's going on and the dire needs of what's happening.
Well, they're often seen as the bad guy, the landlord. You have to pay on time every month. But just like many tenants, many of them are having a difficult time getting by as well, with little to no help in sight. 7 on Your Side investigative reporter Dan Kraus shows us why some building owners say they're on the brink of catastrophe.
During the height of the pandemic, we showed you how renters left in record numbers. Some headed north of the city.
I felt like I absconded in the middle of the night.
Others went south to Florida.
All the things that I loved about New York City kind of just disappeared because of COVID.
And some to the Midwest.
I felt bad about leaving.
Now we're hearing from some of the landlords left behind.
Yeah, it's a good size.
In the past 20 years, Stacy Goley has never seen her rental building in Harlem this empty.
It can't just be one-sided. And at this point in time, it's very one-sided. And it's really, really scary.
She says it's not just tenants who are struggling. More than half of the apartments are vacant.
Even though these apartments are vacant right now, I'm still paying as if the entire building has been occupied.
Which is a problem.
Which is financially detrimental.
Some tenants have experienced rent freezes. There's a moratorium on evictions until at least the new year, but Golia says there have been few breaks for smaller landlords like herself.
It's a really hard situation all around, because if there's no money coming in and you still have to provide basic services, it becomes a major financial struggle.
She worries monthly not only about being able to pay her mortgage, but property taxes. For her, $100,000 this year.
There's rent pauses, there's court pauses, but there's no pause on property taxes.
And she's not alone.
This is the tip of an iceberg, and it's...
So as you can see, right, and I think if you are a landlord, you probably understand and sympathize with this as well. If you're not, you can at least understand the scope of what's going on and what's been happening. And we've seen quite a few pauses, quite a few changes within within what's happening, and wanting, of course, to prevent as many renters as possible. But again, renters have to live somewhere, and you got to protect the individuals that own buildings as well. And this is some of the pain points that we're seeing, and this is the part that gives me a little bit of maybe things are not all that exciting and awesome. And it's very localized. That's the crazy part of the whole thing. It's very, very localized. For some individuals, this is basically nothing. You are good to go. There's no challenges, there's no issues. Everybody has been paying on time, and there's no problems whatsoever. For some of you, you might be in a situation where building is pretty much vacant. You're not getting anybody in. Those that you're getting in, you have to provide all kinds of concessions, lower the rents, and you look at the numbers, and it's just not sustainable. And at some point, you run through your reserves, you run through your credits, you try to refinance, you try all kinds of crazy things, and that's that. So I do hope that that whatever regulations and stuff come in, and that the challenge with the Fed and them coming to help in, they've been helping big businesses, not small businesses. So individual investors, small investors like you and I, have been receiving basically zero breaks. The only thing that is left for you is potentially forbearance. But again, the property taxes, you're gonna have to pay those, or else you will land on one of the sites that I teach folks how to buy those properties, and buying them for pennies on the dollar. So one of the things, my heart again goes out to all of these folks, and I do want to go out and kind of say of like, hey, maybe this is something that we should pay attention to what's going on and what is happening. So hey, I do want to thank everybody who is watching this live on onedealaway.com. If you're watching this on YouTube, smash the like button, subscribe button. I'm about to go into some of the Q&A with the folks on One Deal Away and with the folks over on the Facebook. But for everybody else, hey, thanks for watching. If you will subscribe, if you will hit notifications, I will see you tomorrow. Until then, stay forever money blessed, and do remember, you are only one deal away.